Wharton School Professor of Finance Jeremy Siegel joins us now. Professor Siegel, I was really interested in talking to you today because you've been sort of beating the drum on the disinflation story and that the Fed should stop raising rates. Are you worried that we might see a new wave of inflation with all this strong data?
No, I'm not. Let me tell you why. This is a very interesting fact. I was just reviewing the data. Last year, we hired almost 5 million new workers on net farm payroll, and we got GDP growth of less than 1%. It was the worst productivity performance in over 70 years. This year, we are hiring at less than half the pace, and we have 2 to 3 times the level of GDP growth that we had last year. Why is that? One of the biggest bounce backs in productivity that I've ever seen. And that's saving Jay Powell. That's why we could have this tremendous GDP growth and yet still have the disinflationary trends that are in the economy. Now, it is true. Oil stopped going down, commodities have stopped going down, but I don't see those as starting a new trend. I see the productivity as being a basic deflationary force that will keep that inflation in check.
I get it, but we still have a tight labor market, and that is pressuring wage growth higher. I mean, in the past, a 2% rise in the unemployment rate was required to bring down wage growth by the amount that is needed today.
But wage growth is, first of all, two parts of wage growth. One is productivity. If the worker is actually producing more, then he or she should be getting paid more. So if we have 2 to 3% bounce back in productivity, and we have at least that would actually justify wages being 2 to 3% higher. And also, we have a catch-up. So, even though the last year over year, real wages have increased, since the pandemic in March of 2020, real wages have fallen behind. Especially, you take a look at the UAW. They were under 3-year contracts, 3% a year. Well, when you have 9% inflation, you're going to fall behind. They're asking for some payback for the lost real income. Yeah, that's going to hurt the profits, Ford and General Motors and several others. But nonetheless, I think in many ways they deserve some of that payback, and they deserve a growth in productivity. So I'm not as worried about the wage growth as Powell seems to be, because I don't think that actually means a new inflationary spiral.
Professor Siegel, in terms of how the stock market has been digesting all of this, it seems as if there was great comfort that we were headed for something approximating a soft landing in the economy. And very quickly that turned into, wait a second, maybe the economy is reaccelerating. Maybe it's a little bit too quick. Maybe rates have to go higher on the long end. And can stocks handle that? I mean, you could also just say that the stock market needed a pullback because of the run it had before this anyway. But how does this all play out? Because it seems like higher rates than the economy can handle means we all of a sudden might be looking into next year for saying, do we really have to choke off growth? Does the Fed have to do more? Or will rates themselves tip us into a downturn?
Well, Mike, one of the basic things we teach in economics is that real interest rates are very linked to real GDP growth. So, you were talking about that earlier quite correctly. The acceleration of real GDP growth means higher real interest rates, and therefore higher nominal interest rates for any given rate of inflation. Why is that not tanking the stock market now? Because real increases in productivity and real growth increase profits. So therefore, we have that great battle between the numerator and the denominator of what gives us stock prices. Profits in the numerator look a lot better than they did 3 months ago, even though that denominator has gone up. So the bond market has not done well. The stock market is holding its own.
And you think it can continue despite this wobble?
I think it could continue. Now, this is a big increase in real rates, justified, I think, by the increase in growth. I do think that, Chairman Powell and the Fed have to be very two-sided. If they see a slippage of that productivity growth and, any sort of increase in initial claims, and again, we got another good number for claims this morning, he has to think about not only holding, but do I have to decrease the rate? Don't forget, we are going into political season. I guess you could say we're in political season and have been for a long time. Pressure is going to be mounting not to get a bad employment print. And he needs a dual mandate. So I think that he will be responsive, certainly more than I thought that he would be 6 or 12 months ago.